10-year note yields matched the year-to-date low print as we saw buyers continue to come in, and demand remains very high for treasuries as those yields remain stubbornly low. But we're unable to build momentum. We get south of 2% and then things just sort of slow down. Now, they haven't retraced, and any retracement we've seen has been very modest, but we see the buying end. And whether it's system buying, whether it's want versus need buying, it slows. The market slowly sees yields trickle higher, and then that buying demand comes right back in. So at this point, we are still awaiting that punch down to 185, which, as you recall, will be the level we took off at in November of 2016, right on the election. So right now we are still above that, not very far above it, but we continue to sort of slow momentum as we get to that 2%, and we gravitate back to 2%. That's kind of where we've been and are continuing to trade as we speak. And if you look at market volatility, the market's still holding at that 2%, and volatility now starting to decline the longer we stay there. So we're back to the early June levels that we saw prior to the big spike amidst the trade war talk and amidst the Fed and all that. And it seems to me that right now the market feels very comfortable and doesn't expect a big move. Yeah, we could see yields continue to trickle lower. That would go along with the trend, which would implore even lower volatility. So right now, lower vols don't necessarily take into reading all the geopolitical risks, all the global growth issues that we're having, and possibly any other breakout moves in any other extenuating markets. But right now, we are hovering at 2%. The market seems very comfortable with that. And lastly, let's talk about what the Fed speakers are doing. Last week, it was Mr. Bullard and Mr. Powell talking about maybe walking back some of that dovishness from the June FOMC. And today it was Cleveland Fed Mester talking about the needs of not cutting at the July FOMC, something the market has been hanging its hat on for quite some time. I don't think the market bit on her speech today over in London. However, it's interesting to see the Fed continue to try and walk that back. They maybe got a little over their skis, a little too aggressive at June FOMC. And at this point, it seems that the market wants more than one cut, or at least is anticipating a cut plus. And the Fed wants to take you back to maybe what if we don't cut? What if we only cut 25 basis points and wait and see, and the market just isn't having it. So right now, after seeing the Fed move closer to market expectations, we're starting to see them try and walk back, and that doesn't usually work well for the Fed. So at this point, yields are going to continue to go lower, albeit slower, south of 2%, but they're going to remain stubbornly low for quite some time. And over on the other side of the aisle, the equity market's very quiet today, which is rare. So Treasury is seeing a bid and lower yields, while the equities seem eerily silent.